when you're expecting bad news, then the bar gets lowered. Is earnings season going to be able to clear that bar? What are you looking for?
I think so. I think the market fully expects a pretty lousy earnings season. What's going to be more important are companies' commentary on the back half of the year. And if we can start to see some of those earnings revised up then for the back half of the year, I think that's going to be enough for the market to get going again.
Andrew, you're a little more cautious about earnings this year, aren't you?
Well, I think, look, it's more to do with searching for the reason for the market to sell off. I think the market's going to rally here in April. It's a good month. But as we get up to all-time highs, again near to 3,000, then you have to start thinking about reasons for a correction. And I think, maybe earnings is one of them. Although I agree with Kara. If you look back to 2016, we had 2 quarters, first and second quarter, of negative earnings growth. But because the Fed had pivoted, the market just powered right through that, ignored it, and anticipated a recovery in the second half of the year. So I think that's one reason not to worry about earnings. But I think the point is as we get higher, you start to think about what could be the risks, and that could be one of them.
Should we be worried about valuations, Kara? I mean, if you take a look at the S&P 500 forward multiple, we're just about at the levels we were at before the big October before the sell-off began last October. And if you take a look at individual sectors, we're at all-time highs effectively in information technology as well as communication services on the S&P 500. I mean, do we have to think, are these multiples justified based on the contraction in earnings that we are expecting?
So I think valuations overall for the market are relatively in line with historical averages. But as you point out, there are certain areas of the market that are looking quite lofty. And I would agree. I think technology actually looks a bit overextended here. Valuations, they're okay, but earnings growth is about in line with the market. And then, of course, when you take into account the very long queue of companies that are looking to come public over the next few months, about 2/3 of those actually don't have any earnings. That's a ratio that we saw back in 1999. You throw on top of that, last quarter, technology had the highest proportion of negative earnings guidance. So I think there are pockets in the market where valuations look stretched.
Andrew, where do you stand on how we're valued going into earnings season?
I really don't think valuation is a reason for concern, not with the alternative of where yields are on bonds right now. So, yeah, the market's a little bit above average PE, but I don't think that's a big deal because of the alternative is just not that good. As it pertains to tech, look, technology stocks are, there are a lot of technology stocks that are not back to their all-time highs of last summer. It's just that certain pockets like cloud and software names, they're the sky-high valuations. So I think there are still opportunities within technology.
And finally, Kara, what about places like energy or financials?
Yeah, financials, I think that's an area that's very interesting. It's lagged significantly last year and has finally started to catch some wind as yields are going higher. I think those are companies that are very heavily regulated. Valuations there look very, very attractive. So I think those could have some wind at their backs for the second half of the year.
All right.